Hello traders, Gary Wagner here just after 1:30 in Honolulu, 6:30 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 17th day of January, 2020, and this is the daily report for gold and silver, our weekend review. And what a contrast to trading activity this week when compared to last week. Tremendous price range throughout all of last week. In fact, on Wednesday of last week, we saw a $60 price differential between the intraday high and low, whereas this week, the entire week's range was about $25. It seems as though traders and market participants are settling back now that many of these fundamentals that were imminent have occurred and factored into the market. On today's show, I do want to finish our discussion on potential corrective models. And although we have seen the precious metals move higher today as well as Wednesday, it did close lower on the weekend. I'm not convinced that this correction is over. But we'll talk about that when we pull up our charts. First, to the price board. Today, gold did finish off the week with a respectable gain, up on the day, although down on the week. Current fix is $1,557.30, a net gain of $6.80. Silver also had a nice gain today, about 10 cents, $18.04. Platinum over a 2.5% gain, $1,027. And finally, the unstoppable precious metal, I'm calling it the red Russian metal, in that this metal is red hot, and the entire move higher in the precious metals was accomplished with some headwinds from a stronger U.S. dollar, 97.40, up 33 points, and there's the fact that we have seen U.S. equities hit all-time record highs once again. That was the NASDAQ. This, of course, is the S&P, and finally, the Dow Jones Industrial. So traders, as you know, for the entire week we have been going over different types of corrections, but today I want to take a different tact and look at a more general approach. I've just put up what is called the Elliott wave rules. This was coined by Elliott Wave International, and basically what it states is, in the most simplistic manner, what we can expect in terms of a wave count. As you can see, all of the techniques utilize the basic idea that wave 1 is absolutely a benchmark, and it's a benchmark by which we use to forecast lengths and time periods of the subsequent waves. Once that benchmark is in place, we use that for a prediction of the second wave, that corrective wave. And here, the example you're using is a 61% retracement, and it is also coming out as a basic ABC. It then calculates wave 3, and they use wave 3 as a 1.618% extension of wave 1. We have shown how accurate that can be. And then when they go to wave 4, if you notice, it is a 0.38% or 38.2% Fibonacci retracement. Now, what they mean by that is typically in the two corrective waves, 2 and 4, one is going to be a shallow correction, one is going to be a deep correction. And so if you have a good sense for wave 2, if it was deep, we can expect a shallow retracement and vice versa. However, what I want to really accomplish now is to talk about how these various corrections can unfold. And to do that, we need to look at some of the charts we pulled up yesterday, which really define different types of corrections. The first example that I do want to use is the way the correction occurred between wave 1, the conclusion, and the corrective wave 2. As you can see, it was composed of a simple A, B, C correction, and then of course each wave is subdivided into its next smaller component. Now, when we look at the chart that I put up on the screen, what you can see are there are certain ways that zigzag ABC can occur, And on figure 13, you see those examples, a zigzag, a flatten, and a regular. This particular example is basically a standard zigzag. The way you determine that is because the C wave falls below the conclusion of the A wave, and the B wave comes within 60 to 75% of the top here, or conclusion of wave 1. Below that, figures 14 and 15 are simply the subdivisions of this type of correction. The next corrective example that I do want to look at and explore is the most current and recent correction that really took us from the top of wave 3 all the way down to the beginning of wave 5, the conclusion of wave 4. And what we can see is this was absolutely an interesting mix of corrective types, because at first we can definitely identify a pennant or a flag formation, and that is this right here. In essence, you have two parallel lines. However, that quickly morphed into a basic, what is called a pennant formation, and that is significant because it is composed of a series of lower highs and higher lows, and that asymmetrical triangle basically is a buildup of energy as the range compresses, energy builds, and then most importantly, when it hits the apex, you get a very solid and strong release of energy. Which brings me to our forecast for next week, because what we need is additional clarity as to whether or not this recent action is still a component of a fifth wave. And what I mean by that is a fifth wave will move in sections, something like a 1, a 2, a 3, a 4, and a 5. Or if the top we saw last week signaled a conclusion to this fifth wave and we are entering an actual consolidation or corrective period, a strong A, B, and C. We'll have to see how that unfolds as more data becomes available. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.